All right. Today is Tuesday, March 22nd, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight, but forgive me if my voice is a little off. It's either I contracted the thing or skinny dipping at the bay last night was a bad idea. Anyhow, we got important stuff to talk about, so here it is. In focus tonight. Comeback of retail. Or is it? Are we really that stupid? We'll talk. But before we do so, grab your tinfoil hats because this is going to be interesting. Let's start by a few facts. Fact number one. We know that the retail crowd includes, specifically since 2020, a lot of brainless zombies who think the stock market is a video game and you put your blindfolds on and you run Naruto style, heads first, buy first, ask questions later. Matter of fact, don't ask questions at all. But these brainless zombies, for the most part, of course, got washed out of this market because a lot of their stocks are down 50, 60, 70, even 90% from the top. So they're holding a lot of bags. The other side of retail investors is a bit more cautious, a bit more educated, and perhaps more long-run oriented. And of course, a lot of us also engage in day trading, perhaps intraday trading, short-term trading. It is the name of the game. And so far this year, for those in the retail community who've been buying the dip over and over and over again, assuming that what happened in 2020 and 2021 will last forever. No regard at all to the monetary policy, to the geopolitical risk, or even the fundamental risk regarding the macro picture and an upcoming recession. This part of retail traders have been catching a falling knife after a falling knife after a falling knife for a long time now. So the message was clear. You gotta be more careful. And I think the majority of the retail community got the memo. So that brings out the question. When you see names like GameStop today, for example, up over 30%, is it really the comeback of retail traders and investors? Or is it something more, shall we say, suspicious? Or even heinous. Because you read a headline like this, for example, today. It says U.S. stocks gained as investors shook off concerns that rising inflation will drag the nation's economy into a recession. You look at all the polls out there, not just among the retail community as investors and traders, but in general, the public. The majority are pessimistic about this economy. The majority are now starting to see the possibility of a recession in the foreseeable future. So again, was it really retail behind the buying today? Now we understand that stocks are not going to go up forever in a straight line. Likewise, stocks don't go down in a straight line forever. You're going to get bounces and rebounds. That is just the name of the game. But today's activity is a little more than that. It's a little more than buying the dip in certain names or playing, let's say, an oversold technical rally. Today was a deja vu of the retail stupidity from last year. Now, do I really have to believe that retail is that stupid? Did not get the memo about the monetary policy? Did not get the memo about buying garbage stocks, did not get the memo about the geopolitical risk, did not get the memo about peak corporate earnings, did not get the memo about the yield curve, the possibility of a recession, did not get the memo about insider sales, who all of these corporate insiders bailed out last year at the top. I really doubt it. I doubt that retail is really that stupid to participate in the mania that we saw today. But hey, Jerome Powell came out yesterday and said that he will need to adjust the policy as needed to tackle inflation, but also avoid the recession. Look at Jerome, busted, we got you. But are we stupid to believe that we just trusted Jerome Powell again, the man who's been wrong for over a year now about inflation, the guy who couldn't even fix a cup of coffee the right way? Now we're going to trust this guy that he's going to engineer a soft landing and avoid a recession when he's about to tighten like crazy and this inflation is getting out of control? Are we that stupid to engage in reckless activities in the stock market based on this assurance? I doubt it. I think that there is something more sinister here. Now, don't get me wrong. I believe that some of the action that we got today is due to retail participation. No doubt about it. Because if it was the institutionals, they would have bought in the pre-market. They would have pumped in the pre-session. We would have seen these massive gaps higher, just like we've seen back in the post-election in 2020. And we've seen that pattern repeatedly when the institutionals are doing the pumping. So no doubt about it. We have a chunk of retail who participate today because the buying happened right after the open. But there are also suspicious elements here that we're going to discuss throughout this video. But just a reminder to set up the stage for you. Is the retail community this stupid because We got warnings after warnings after warnings. And it is becoming clear now that the stock market will get hit pretty hard. As a matter of fact, the economy might dip into a recession. You can bet on that now. Because it is not just me or Larry Summers or Mohamed El-Arian or the other economists who've been warning about stagflation and the fact that the Fed is wrong about the monetary policy and the outlook for inflation. It is now everybody, including the Fed, including the doves within the Fed. Today we heard from Zombie Daily from San Francisco's Fed, and she backs marching interest rates up to a neutral rate, maybe higher. This is the same Zombie who last year, we're not talking about a year ago, we're talking about a few months ago, we're talking back in October, she was saying that inflation is transitory, no need to panic, no need to overreact. Now she's saying we need to up it above the neutral line. Another Fed zombie from Cleveland spoke today, Loretta Mister, and she's now in favor of front-loading interest rate hikes. What's going on here? All of these Fed zombies who've been telling us repeatedly that inflation is going to be transitory, no need for overreaction. Now they're in favor of pretty much crashing the economy and the stock market because front-loading interest rate hikes will do exactly that, because they now know that there is no other alternative and they're forced to crash the stock market and the economy because they're way behind the curve. And the last thing this country needs to see is either hyperinflation, stagflation, or even a depression. But it is really peculiar that all of a sudden all of these dovish Fed presidents now becoming hawks. There is an issue of trustworthiness when it comes to the Fed. So are we, again, I raise the question, are we that stupid to believe Jerome Powell that he's going to engineer a soft landing and we should buy stocks, the riskiest assets out there, the GameStops, the AMCs of the world? Even the Dallas Fed came out today and said that with the halt of Russian energy exports, you can bet that a recession will happen. The Dallas Fed says recession is unavoidable without Russian oil. So again, either retail investors are really stupid and they deserve to get slaughtered, or something fishy is going on here. Even Carl Icahn came out today and said that there is very well could be a recession or even worse in his projection of this economy. Despite all of these warnings, despite all of these facts, look at what happened today. The most garbage stocks out there. This is a basket of stocks that happen to be some of the retail crowd's favorite names. You look at a name like COS, for example, up over 29% today alone. You look at a name like Roblox, up over 8% today. A name like GameStop, up over 30% today. AMC up over 15%, Tilray up almost 7%, Blink Charging up over 6.5% today alone. So what happened? Did anything change in the outlook that merits going back to risk on? Because this is risk on. So the question once again, is it really the retail crowd that stupid and that arrogant about all of these facts? Or were there other forces, quote unquote, behind today's action? You look at GameStop, for example. I did not see anything suspicious when it came to the options market action. No suspicious buying ahead of time, nothing like that. And the buying started early in the morning. So you could convince me that the retail crowd was behind buying GameStop today, okay? But what about Tesla? Another name that is favorable by the retail crowd community. Tesla was up almost 8% today alone. On what news? You could say it's due to the Berlin factory, but again, this is old news. We already knew ahead of time that we will have the opening today. Is it due to Reverend Elon Musk promising a master plan part 3, more empty promises? I think before we hear his master plan part 3, one must ask the question, where are the robo-taxis that were supposed to come out in 2019? Where is the Cybertruck? But regardless, what was behind the impulsive move higher in Tesla stock today? If it is not the Berlin news, if it is not the master plan part 3, perhaps Nancy Pelosi exercising some Tesla calls, maybe that was behind the move higher, perhaps. But I like to look at the facts and market mechanics, aside from the theories and the suspicions. And the only evidence that I have is the action from the options market today. And it was absolutely stunning. Now, viewers of this channel are aware of the trader also known as Tesla Whale, who buys block orders of Tesla calls out of the money on Monday and then dumps them around Wednesday, Thursday by the end of the week, producing massive pumps and dumps, short-term profits. We're all aware of that. But look at this. Today, we have seen over 107,000 contracts of the 1,000 calls with the expiration date of this Friday trading today. Meaning this trader or entity, whatever it is, they buy thousands of contracts out of the money. Let's say the 900. They force a gamma squeeze. The stock moves higher. They close these contracts within the same day and they roll higher. to the 1000 and they buy even more contracts, forcing the gamma squeeze to intensify. And then a few days later, they dump all of these contracts, closing all of these out-of-the-money calls that are perhaps in the money now, and the stock flushes down. By doing this process, you could have a lot of mom-and-pop retail investors looking at Tesla. They say, wow, the stock is up 8% today. I guess I gotta buy. They buy by the end of the day, and then this entity, this Tesla whale, whatever he is, dumps on the head of the mom-and-pop retail investors who bought the hype. Isn't this criminal? Isn't this predatory behavior in the stock market? And that brings me back to the point. We're talking about over 100,000 contracts got traded for the 1,000 calls with the expiration date of this Friday. This is not an entity that is interested in buying the stock. This is an entity or persons interested in pumping and dumping the stock in the short run. When we talk about 100,000 contracts trading for the name, we are talking about a notional value of over $10 billion traded for Tesla today for one contract, the 1,000 call with the expiration date of this Friday. Now, are we that naive to believe that the retail community was behind pumping a notional value of over $10 billion worth of Tesla stock for one contract in a single day? It is almost impossible. Something sinister is going on here. You might ask, where is the SEC? The answer is the SEC remains in a coma. And your boy Gensler, his priority right now, not fixing this mess, his priority is climate change. Oh, the SEC is going to tackle climate change now? And look, stocks can move up, can move down, doesn't matter to me, so long as they move fair and square, not due to market manipulation. We talked about market manipulation from the hedge fund shorts who overshort a position, for example, forcing that particular stock to crash. But we now know that there is a consequence for that. It is called a short squeeze. What is the consequence for manipulating the stock market higher, manipulating individual equities higher? What is the price for that? What is the risk for that? It is actually risk-free because the SEC is in a coma and these entities and individuals can manipulate the stock market so long as they're manipulating it higher. And I tell you where the consequence is, not for these predators, but for those of us who believe the hype and buy these pumps and then they end up holding the bag. We've seen this movie before, not in 1999. You don't have to go back all the way there. We've seen it last year. We're talking about stocks, the 2020 darlings, the stay-at-home darlings, all the pumping on TV, all the manipulation. And a lot of retail investors ended up holding the bag. We're talking about 50, 60, even 90% from the top. Look no further than Peloton, for example. The stock is down big from the top after all the pumping, and the insiders walked away with hundreds of millions of dollars. For the retail investors who bought the hype and bought Peloton at the top or close to the top, it's a different story. So what do we do with the action that we got today? Well, according to Morgan Stanley's Mike Wilson, they say he's a perma-bear. I say he's a clown. Because his whole spiel is, oh, the market is going to go down 10%. It's a correction. It's not the end of the bull rally. It's just a 10% correction. And then it doesn't happen. It doesn't happen. It doesn't happen. And the guy keeps repeating the same narrative over and over and over again. And then it happens, and everybody acts as if Mike Wilson is some genius. I say if you're going to be fraud, follow Tom Lee's style, who've been saying, oh, the stock market just going to go higher, continue to buy the dip, buy the dip, buy the dip. But at least that works in a hyper bubble mania kind of stock market, just like we had back in 2020 and 2021. But regardless, let's hear what Mike Wilson has to say here, because once again, eventually he's going to be right. Investors should use the strength to position more defensively, as the U.S. economy is in a late cycle expansion phase. Wilson and his colleagues wrote in a note, upgrading utilities stocks to overweight bear market rallies are the most vicious, he said. Meanwhile, Morgan Stanley's European equities team lowered its forecast for earnings growth in Europe from annual 10% to just 3% for this year. I remember that Morgan Stanley in the beginning of the year said we should buy Europe and dump the US because European equities are cheaper. What happened to that? Morgan Stanley now says we continue to see the MSCI Europe risk reward as unappealing at this time. Oh, really? But Wilson has a point. The most intense rallies happen in bear markets, not bull ones. For example, last week's rebound produced over 6% gains for the S&P 500, and this was the highest weekly gain since 2011 if you don't factor in the thing crash back in 2020. And as you can see from the chart, the most intense rallies that produced 5%, but even more than that, sometimes double-digit returns in a short amount of time. The majority of these pumps happen in bear markets. And the strategy in a bear market is the following. I've been teaching you this for a long time now. You buy the stocks that are still in a bull market territory, and you trade the stocks that have become oversold. You buy calls. You ride the bounce for a little while, you take profits, and you say thank you, goodbye. And perhaps you might want to think about shorting these names. Now, last week, March 16th, after Powell's conference, I shared with you some names, some charts that were amidst the process of a bear market rally, an oversold bounce, whatever you want to call it, doesn't matter to me. And I could have done a better job in picking names, but it doesn't matter what name you pick. So long as it is oversold, it's going to bounce higher. So let's hear some of these names that I shared with you and get an update after that. I'll give you some names. How about Autodesk? This is a weekly chart. Look at the RSI. I want you to look at the RSI. Oversold, waiting and waiting for any good news to pop higher. Today was the day we got a massive pop for Autodesk. Another name, Alibaba, a daily chart. It got severely oversold. And again, any hint of good news will force tremendous short covering, and hence you get the massive rally that we got today in the name. Is it going to last? The assumption is maybe for another day, another week, but sooner or later, these stocks, which are in bear market territory, will have these bounces and then they will resume the pain ahead. Another one, BLK, BlackRock, a weekly chart, way oversold in the RSI. Today was the day when the good news, quote unquote, came out, and here we go, a massive bounce for BlackRock. Another one, CRM, Salesforce, a weekly chart, oversold in the RSI. Any good news will pop the stock higher in a bear market rally. JP Morgan, a daily chart, way oversold in the RSI. Any good news, any movement in the 10-year yield higher, and you see the stock blasting like we saw today. Another one, MCD, McDonald's, a daily chart. It has been in a free fall, but again, it got really oversold, technically speaking, on the RSI. Any hint of good news, and you see right away the bear market rally, the oversold rally working out, producing impressive gains. Either you catch these or you're going to miss them out because they're not going to last for too long. And the risk is you jump in the wagon a little too late and you eat a pie in the face. Here's another one. The ticker ROKU, Roku, a weekly chart. Way oversold in the RSI, and it is bouncing higher today based on the good news that we got. And the assumption is this bear market rally in Roku could last for more days, perhaps a few more weeks, and it will produce sizable gains. It produced double-digit gains today alone. So let's say tomorrow we get another 5, 6, 7, 8% in Roku. Now we're talking about 20% gains in a couple of days. And therefore, you fix those oversold conditions quickly and the bear market fades away. This is the risk with these names. Here's another chart. The ticker SNOW for Snowflake. And this is a daily chart. It got really oversold and hence the oversold bounce, the bear market bounce, whatever you want to call it. Is it going to last? For a little while, for sure, but sooner or later, the best case scenario for this chart is consolidation, because this is how bear market charts trade. They have these massive bounces, and then they flush down again, or once they find a bottom, they consolidate and trade in a boring manner for weeks, if not months and years, before they start moving higher again. But I think the risk here is we have certain market participants who believe in the fantasy that some of these charts will trade back to all-time highs. It's not going to happen. It's going to take months, not years, for some of these charts to reclaim the all-time highs. Another one, Spotify, the ticker SPOT, weekly chart, got really oversold in the RSI. Today was the day for the bounce. Here's another one, the ticker WING, Wingstop. This is a daily chart. It got really oversold in the RSI. And today was the day for the rebound. And lastly, what about Zoom, ZM? Way oversold on the weekly chart. Today was the day for the bounce, and Zoom scored big. Here it is. Since March 16th, you have Autodesk up 6%, Alibaba up 10%, BlackRock up over 2%, Salesforce up almost 6%, Morgan Chase up almost 3%, McDonald's was flat, Spotify up over 10%, Roku up almost 10%, Snowflake up almost 14%, Wingstop up almost 4%, Zoom up almost 12%. And this is not just from the bottom. This is since March 16th. So clearly, there was a lot of meat on the bone to chew on. Even after the rebound happened, we waited for a confirmation. We bought some calls for these names. Now what happens? After a massive bounce like this, I'm booking profits. I bought the calls for a specific purpose, and that was already served. Am I going to short these names now? Not really, but I'm booking profits for now, and I'm sticking with my names, the names that are still in a bull market territory. Now look at the action that we got from these names today. We're not seeing a massive rotation. We're not seeing a rotation at all, matter of fact. If we're back at risk on, and this is a legitimate market rally, we would have seen a rotation from the winners to the losers. Just like we saw back in 2020, we witnessed the rotation from the NASDAQ to the IWM and the cyclical reopening trade. We tracked all of that action in details in this channel. So far, we're not seeing the same action here, moving from the inflationary theme back to risk on the high multiple, high beta, the software, chips, retail crowd favorite names. We're not seeing that rotation, at least not so far. Matter of fact, a lot of these names managed to close in the green, even today. Now, we have some losses for Mosaic, for example, down a little over 2%. But this is not a big drop. This is not a rotation out of the name. Perhaps it is a reaction to a specific piece of news that I'm going to share with you in the commodities coverage. But again, these are modest losses across the board. With the exception of ZIM, we talked about this name in yesterday's video. It was dividend day, and again, we're talking about the most generous dividend in the stock market. Of course, we're going to have some profit taking and dumping of the stock. This was expected. But you're also going to see the dip being bought in this name again due to the generous dividend and the fact that it is beating inflation for now. And by the way, we have other stocks beside this list that are also beating inflation. And if you want those, it's $2 extra. That's a lot better than the $3 extra that you have to pay these days for a slice of bacon or avocado. Anyways, folks, we're going to talk about this and a lot more throughout the coverage, but we have to start by the closing of the indices today. And here we go. The Dow Industrial Average closed in the green by 254.47 points, or a gain of 0.74%. The Nasdaq also closing in the green by 270.36 points, or a gain of 1.95%. The S&P 500 also in the green by 50.43 points, or a gain of 1.13%. And here are the sector's performances today. Leading the pack at number 1 and capturing the gold medals, cyclicals, and at number 2 for the silver, communication services, number 3 for the bronze, technology. The laggards of the day, the defensives, believe it or not, the new defensives, energy, materials, and utilities. Moving on to the advanced decline ratios, NYSE 64% advancing versus 32% declining. The Nasdaq 70% advancing versus 24% declining. Moving on to commodities. What's going on here? We're going to talk about the chart of Brent, and it will explain to you why Brent faced some stiff resistance at around 118, 119. But we saw a pullback today, likely to be bought again, by the way. The WTI closing the day down almost 1%. Brent down a little over 0.5%. Likewise, gasoline was down a little over 1.5%. Heating oil, on the other hand, closed in the green, gaining a little over 0.5 percentage point. And natural gas was the winner in energy commodities today, closing the day with gains of over 5%. Softs, lumber is down almost 1.5%, OJ down a little over 2%, and then we have flattish activity for coffee, sugar, and cotton, while the winner in softs was cocoa, gaining almost 2.5% today. Metals down across the board, be it modestly for gold, copper, similar story, but we saw some profit taking in silver, down a little over 1.5%, similar story with platinum, but most importantly, palladium was down a little over 2% today. Meats, flattish across the board, live, feeder cattle, lean hogs, all flat, nothing notable here. What about grains? The most important commodity to watch is wheat, and wheat was flat today. Yet we have gains led by canola, soybean oil, rough rice, soybeans, all closing in the green. But we have a pullback led by soybean meal, oats, and corn. We have some good news regarding the strike that we talked about in yesterday's video for Canadian Pacific Railway. For now, we have an agreement with 3,000 workers to end the strike. Now, is this going to be the end of this strike or the end in the inflation and grains prices? Of course not. This is just one tailwind among many. Moving on to the big casino, the options market. What's going on here? The hottest table by far today was Apple at around 1.3 million contracts traded today. About 62.5% of those were calls. The number 2, Tesla, the souffle. We're seeing massive bump in the volume. The name closed the day at around 1.2 million contracts traded today. About 65% of those were calls. And look at AMC. The call options in AMC scored the most, by the way. And the reason is the implied volatility for AMC was down compared to, say, Tesla, Apple, even GameStop. So those who held on calls, you scored big. AMC at number 3 with around 700,000 contracts. About 77% of those were calls. Moving on to the unusual activities that took place in the options market today, we start with the ticker BCS Barclays. Interesting, a unique trade. We don't see Barclays here, often at least, but here it is. They're buying calls, the $10 calls, and bear in mind, Barclays got entangled with the VXX, that whole fiasco, so it could be related to all of that, but they bought the $10 calls for the expiration date, May 20th, with the expectations that Barclays could continue to move higher by more than 7.5% by then. They paid around 45 cents a piece to enter this trade, all in all spending around $600,000. And here it is, a massive pump for the souffle, really suspicious, but we're seeing fading the rip here, a lot of put options buying today in the unusual trades. Of course, the majority of the call options buying was the pumping, buying these contracts for the expiration date Friday, in and out, in and out, in and out. I did follow this trade, by the way, because my initial put trade for Tesla served me a nice pie in the face today. So I'm going with this one, and then I'm going to start to roll down if it works. Here it is. The trader bought the 940 puts, and they sold the 930 puts, all for the expiration date of this upcoming Friday. So this is a high-risk trade, so you have to open spreads. If you have a longer expiration date, then you don't have to open spreads right away. But with 3 days till expiration, you gotta buy spreads. In this case, they paid around $6.20 a piece for buying the 940 puts, and they received around $4.70 a piece from selling the 930 puts. All in all, approximately, the entry cost for this trade is around $1.50 a piece, which brought the total all the way to around $1.8 million. And here it is, AMC, somebody's fading the rip with the expiration date of Friday, and they bought the $17 put with the expectations that AMC could drop down by more than 7% by Friday. They paid around 35 cents a piece to enter this trade, all in all spending around $400,000. What about the ticker SHOP Shopify? They're buying calls, big time, lots of risk taking here. This time around the 800 calls, the expiration date, this upcoming Friday. Now notice that the majority of trades today were pretty much for either this week or next week's expiration, meaning we're not seeing conviction in the buying, at least not according to the options market. Anyways, the expectations from this trade is for Shopify to move higher by more than 10% by Friday. They paid around $4.75 a piece to enter this trade, all in all spending about $4 million. And lastly, what about the trade for the ticker MULN? This is for Mullen Automotive, and the name is down big year to date. Stunning, down almost 50% so far this year. But somebody is calling a bottom here. Now watch this name, by the way. It could become a meme kind of name. They bought the 3.5 calls for the expiration date, April 14th, with the expectations that the name could rebound higher by more than 6% by then. They paid around $1 a piece to enter this trade, all in all spending around $800,000. Moving on to the heat map analysis. What's going on here? Obviously, profit taking in energy, the agricultural names, the winners year to date, but not really. Defense contractors pretty much flat, railroads, Kroger, ADM, a lot of names managed to perform today or close flat, but the majority of the action was in the losers year to date. Banks, big cap technology names, the stay-at-home names, software, the automotives, specifically Tesla, but they also bought Boeing, the Chinese names. So today was one of those bear market rallies again. And folks, they are intense. Now, obviously, Apple is not in a bear market, for example, so you got to distinguish between all of these names, although Apple flirted with the 200 days moving average not so long ago. Now, let's talk about specific news for certain names, and we start with Alibaba. Alibaba surged higher. Obviously, the name is down big, but we're seeing attempts to buy the dip, specifically from the retail crowd and pumps from the Chinese government. And that includes Alibaba itself. Alibaba initiated a program for shares buybacks up to $25 billion. And this is the largest share buybacks in the history of Chinese stocks. So again, another tailwind for Alibaba to move higher. We also have a problem with Disney, even though it closed in the green today, because we're seeing cases of the thing rising higher, and the Shanghai park had to close. Disney is also getting embattled in the political issues down in Florida, and the workers are striking. It's a mess over there. So we're going to avoid Disney for now. We also have news for Lucid. Lucid is using NVIDIA's chips to power the autonomous driving system. Lucid was up today, but NVIDIA did not benefit from this news. I mean, if you're Lucid, you got to produce the cars first. Then we're going to talk about the chips and the autonomous and all of that garbage. Moving on to the heat map for the ETFs. Again, the winners year to date were soft. Look at energy, be it the XOP, XLE, OIH. Look at healthcare, for example, the XLV, the big pharma names, pretty much flattish. The XLP, consumer staples, also soft. The XME, basic materials, also down. Not by a lot, by the way. But the majority of the action was in the high beta, high multiple names. For example, biotech, the XBI was up, XLK, technology, the regional banks, KRE, and the reason is rates are moving higher. It was a growth day, clearly, even though value, by the way, is not down or underperforming by a lot. When we look at international markets, China is bouncing higher, but pretty much everything across the board is bouncing higher. But we look for the consistency here, folks, and the most consistent outperformer is the EWZ Brazil, and that also closed in the green today. When we look at commodities, you're seeing solar moving higher, TAN, the ticker TAN, but also uranium continues to move higher, the ticker URA. We have a lot of good news for uranium due to the rise of nuclear energy planning across the globe. We talked about that in details in a previous video. Let's move on to cover some charts, and we start with the SPY, the S&P 500, 30 minutes chart. What do we see here? It was gap higher kind of day, regardless of the weakness that we saw in last session. Yesterday, they shook out the bulls, they scared them away, they shook out the bears, and now they're pumping the market higher again. The chart flirted with 451, but a lot of other folks have 450 in their chart. It doesn't matter. It is a zone, not a specific number, but the chart went all the way to this resistance at around 450, 451, and it is consolidating in a bullish pattern. The chart is getting a little overextended in the momentum indicators, but we did not see a massive pullback in the previous extension. It was consolidation, a drop, intraday drop, but it wasn't that big. So the SPY has more room to go if it wants to. It can go all the way to 454, but after that, it's going to become obvious that you got to short the rip. Now, what if the chart goes down in the morning? Then we have 446.5, that is support number one. Then we have the gap between 443 and 446.5. If the chart fails to bounce after closing the gap, we will look down at 443. If the chart closes the day below 443, then we got a solid confirmation that the recent trend is running out of gas, and perhaps you should either take profits or start to short, because we're not giving the SPY one target. We're giving the SPY 446.5. We're giving the SPY the gap. We're also giving it 443. So we're being really generous and liberal with the targets. But you close the day below 443, then you got no excuses anymore. And here's the daily chart for the continuous contract for the SPY, the S&P 500. Major progress for the bulls, and the reason is the chart recaptured 4,472. So we have a lot of cushion before we start shitting our pants. What is the point where you're going to start shitting your pants again if the support of 4,232 is broken again? But before the chart does that, it's going to become clear, because you have the support of 4,384.5, and now you have the support of 4,472. So we now have plenty of support before we start shitting our pants. The momentum indicators are shooting up higher, but it appears that they're starting to peak. The volume was way below average, which is concerning, by the way, because in a sell-off, we see the volume increasing, and when the volume reaches a peak and starts to trend down, it is a sign and a signal that we're getting closer to a bottom. If not, we've already seen the bottom. Likewise, when you have a rebound rally higher, when the volume plummets down and it bottoms and starts to spike higher again, it is a sign that the chart is stopping, erasing, or at least pausing the recent trend. For now, we don't have a confirmation that the volume is about to spike higher again, but what if that happens tomorrow? Then you'll know the deal right away. And by the way, here's the SPX, the cash index. It managed to close above the 200 days moving average, so this is a decisive victory for the bulls. But here's the problem. Will the chart close the week above the 200 days moving average? Because what if this is a trap? You get a pop over the 200 days moving average, you excite the algos, the retail crowd, the dip buyers, and they flush down by Friday, and the chart loses the support of the 200 days moving average. But if you have a weekly closing above the 200 days moving average, then you got some cushion, and you'll know when the chart is about to reverse and go back below the 200 days moving average. What about the Qs? 30 minutes chart. Similar story with the SPY, although the Q Qs did not gap higher. And this kind of solidifies my theory that we have some retail elements in the buying today because they bought right off the gate. And now the chart is trading above 352 and it is consolidating in a bullish pattern. The next resistance it's eyeing is around 360. Could it make it all the way there? Yes. The best case scenario for the bears is we have a gap and crap. So the Qs gaps all the way to 360 and then we see a sell-off and profit taking right away. And of course, preferably closing the day below 352 because that is a cushion that the bulls have before we go down and talk about the line in the sand at around 343. The bulls, if they close the week right here, it would be a decisive victory because they have at least one cushion, which is 352 before we talk about 343. Here's the daily chart for the continuous contract for the Qs. A massive rep higher so far since last week. We now have a lot of cushion. We have 14,000. We also have 14,445 before we start talking about 13,599, which is the line. If the chart closes below, we're going to start grabbing a lot of diapers again. The momentum indicators are moving higher, but are they peaking? That is an important question to ask. Likewise, the volume, similar discussion with SPY, are we bottoming in the volume? And are we about to see a resurgence of the volume, specifically selling and taking profits? At least the VIX suggests that. We'll talk about the VIX in a minute. But before we do that, here's a 30 minutes chart for the IWM, the Russell 2000. We talked about the trap. Yes, it looked like a bear flag pattern, but the confirmation would have been closing the day below 204.5. But if you took a shot and you shorted anyways, it's not a dumb decision because we are in the risk-reward kind of business. Yes, you got a small pie in the face today, but if you set up your expiration dates correctly, you might actually score because the chart went all the way again, 208, and it did not make it above that. It is now consolidating in what it appears to be a bear flag pattern once again. And once the chart breaks 204.5, you might want to double down and average down on your trade, and it's going to be a profitable trade. What about the Dixie, the dollar index? It closed in a bad-looking candle. You can call it a shooting star, you can call it whatever you want, doesn't matter to me. But in the grand scheme of things, the confirmation that the dollar is reversing the trend is not going to happen until we breach 97 as support. But we're not there yet. Yes, the dollar is in negative divergence in the RSI and MACD indicators, but it is consolidating within a range. Who's to say that the overbought technicals, the overextended technicals, is not going to work their way as the chart consolidates for a little while, and then we see the chart shooting up higher again. And that leads us to gold. I'm not liking the action in gold here. We need a pump by the end of the week. Otherwise, this consolidation is in a bearish pattern. Sooner or later, the chart could go down to the next Fibonacci support at around 1,850, which happens to be also the trending line of support. But a pump higher, let's say recapturing 2,000 by the end of the week, will give the gold bugs the comfort that they need to hop in and buy the dip again. What about oil? Let's talk about Brent. Yesterday, we identified 118 as resistance, and I said that the chart will face some stiff resistance there and we will see a pullback. But that pullback will be bought again. So far, we got a pullback at around 118, 119 within that zone. The consolidation for now is bearish because you have a bear flag pattern. It appears so for now. You have the RSI and the MACD indicators, at least from the 4 hours perspective, in negative divergences. That doesn't mean that the chart has to flush down dramatically because these are intraday charts. This is a 4 hours chart, not a daily, not a weekly. And my hunch is they're going to buy the dip again and we will see 118 being recaptured as support, and doing so will initiate the next leg in the rally in oil. Here it is, the chart of the day, the chart of the week, the 10-year yield, a massive pump higher. We're now above 2.34, which was my number. The technicals are getting really extended, but who's to say that the chart is going to pull back next week? Not this week, not tomorrow. And again, who's to say that the chart is not going to pull back tomorrow? The bottom line is we know that the chart is going to pull back at some point. We have to look for a catalyst. Is it going to be that inflation expectations went down? No chance. Is it going to be because growth expectations went down? Perhaps. Is it going to be due to the flare-up in geopolitical tensions between Russia and Ukraine? That is perhaps the greatest possibility. And if that happens, we will see the 10-year yield pulling back and the TLT pumping higher finally. The TLT is getting a little oversold. This is a weekly chart. The dailies are even more oversold. But we have to look for the support at 128. Is the chart going to bounce from this particular number, or is it going to breach below? A breach below 128 will open the floodgates and we will see massive dumping of bonds across the board. But if we have a rebound at 128, you got to combine that with the fundamentals. What was behind the rush in buying bonds? Was it growth, scarce, or was it geopolitical flare-ups? If it is the latter, then it could be a temporary rebound because they go back and forth all the time. We're going to have a peace deal. No, we're not going to have a peace deal. This guy's going to talk to that guy, and they continue to pump the market that way. It happened during the thing. When we have good news about the thing, stocks go higher. It happened during the trade war. Every time we have rumors that we're going to have a deal, or China called. Remember that one? China called. If it is one of these temporary reasons for the TLT to move higher, then trade accordingly. If it is a growth kind of scare and the 10-year is about to collapse, then that's a different story. And here's the VIX 4 hours chart. Look at the MACD indicator. Look at the RSI. It appears that we're just stretching the rubber band and the VIX is about to explode higher again. So watch out here, bulls and the dip buyers. Don't get too complicit, because you should not be too complicit and assume that it is risk on until the VIX closes the week below 20. So far, we did not get that yet. It looks as if the VIX is staging another massive pump higher. What about the VXN 4 hours chart? It went back to 27.5 to retest that as support. Can we have a double bottom? The VXN starts to bounce higher. That is the case. The Qs will be soft. The Qs will top for now. If we have a breach below 27.5, then in all likelihood we will see the Qs adding to the gains. But you gotta be careful. Which names are you gonna buy? Are you gonna buy the garbage names, the RKKs and the likes, or are you gonna buy, let's say, Salesforce or Apple, the strong names? And here's Apple, speaking of the strong, moving higher, closing the day above the resistance, now support, the upper range of the trading channel in yellow, and the chart is now eyeing 172.4. You can round that down to 172. In either case, will the chart close the week above the upper range of the channel? That would be super bullish. If it closes the week below that line, then it's going to be problematic, because if it is true that the retail crowd is buying the dip right now as they're trying to sell us, how come the biggest name in the stock market and the most important name, the top favorite name among the retail crowd, couldn't make it above the upper range of the channel by the end of the week? That's an easy task. All you have to do is close flat right now, the next 3 trading days. And here it is, Tesla, the Stagflation hourly chart. It keeps pumping higher and higher and higher. Yesterday I thought it's going to stop at the trend line, and it certainly appeared to be a good case because we had a topping candlestick pattern. It was a solid resistance line, but again, the options momentum is so strong. And today, when the chart managed to trade above the spike top that I identified yesterday at around 942, I had to close the puts that I bought yesterday, and I got a nice warm pie in the face. But I bought puts at the close once again. This is going to be a short-term one, a test. Kind of dip your feet in the water and see what happens, and then I might roll down and buy more aggressive puts. Another important case for buying puts today is when we zoom out. What is the next resistance, by the way? It is 995. So let's draw that line, and here it is. It closed exactly below 995. The assumption is it's going to face resistance here. The chart cannot defy gravity by cracking above all of these resistance lines throughout the week, because if the catalyst for the move higher is a call options pump, a gamma squeeze, then by the end of the week, they're going to start taking profits. You combine that with the fact that 995 was a strong resistance before, strong support before, so you know it is important. Number 3, they bought over 100,000 contracts of the 1,000 calls with the expiration date of this Friday. Can they continue to roll up? Sure. But the assumption is if the charts start to look weak right off the gate in the morning, you're going to see a lot of them closing these contracts, and we will see a flush down in Tesla, perhaps all the way down to the trend line, which is now support at around 920. But don't take my word for it. Do your own diligence, because I was wrong. I expected the chart to stop at 866. And look at the chart, moving higher and higher and higher, cracking above all of these resistance lines. And when we zoom out to a daily chart, we obviously have a bear channel, and the chart made false breakouts before. So the question is, will this be another one? Another false breakout to capture all of these bulls, and then they flush them down? We'll see. The weekly closing becomes really important. Is the chart going to close the week above the trend line or below it? Likewise, when we look at the weekly chart, the chart already broke the trend, an important trend that goes all the way back to 2020. And now we have the rescue, which usually doesn't work out. Sooner or later, we're going to start to see the chart curling its way down and breaching that line of support once again. The question is when, because you look at the RSI and the MACD indicators from a weekly perspective, it looks like they're bottoming. So who's to say when is going to be the point when Tesla reverses and starts to trend down again? You have to factor all of that in, because I'm trading the name based on an hourly chart. So my scope is short. If you're having long range trades, let's say beyond May, for example, or even beyond April, that is considered long term in this unique market environment. We're not seeing a lot of commitments, a lot of convictions. Moving on to tulips, BTC, what's going on here? No update. Yes, above 42,000, but fool me once, shame on you. You know the story.
Fool me once, shame on you. If fool me, we can't get fooled again.
I gotta see the chart trading above the three amigos, otherwise not buying right now. And lastly, what about AMC? Here it is, massive pop higher. Your boy, yours truly, got a little earlier. But those of you who held on the calls options trade, you scored big today. You should have taken some profits, at least 50% of the position out, and then let the rest out. Because if this is a bear market rally, a trap, we're going to see a flush down tomorrow. And that could erase a lot of the gains. But for now, the likelihood of AMC reaching 21 once again and retesting that level as resistance, perhaps recapturing it as support, the odds for that happening improved dramatically. And lastly, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have new home sales, we have a bunch of Fed zombies speaking again, Loretta Mister and Mary Daly, but most importantly, the big zombie, Jerome Powell, will be speaking on digital challenges. You mean the digital printing of money? Anyways, this is all I got for you for now, folks. Thank you for listening, thank you for watching. I will talk to you again tomorrow.